Hi guys, in this particular video we're going to discuss SEBI related current affairs for the month of December 2018. So friends, now the exam is very near and we have tried to cover as much current affairs for the month of December which are very important and which can be asked in the examination. So friends, let's start with the first question. SEBI eases rules for foreign investors, allows side pocketing by mutual funds, etc. So SEBI board has made a slew of changes and let's discuss all these changes one by one. So the first one is pertaining to the rules for foreign investors. So SEBI board has approved a slew of measures at its meeting, and these measures they range across a wide set of issues, and we're going to just discuss all these issues, and one of these is easier rules for clubbing foreign portfolio investment limits. So the board has approved a proposal that clubbing of investment limits for foreign portfolio investors. So the board has said that while seeing the limit for foreign portfolio investors, when we do the clubbing part, we have to do this on the basis of common ownership of more than 50% or common control. So if there is common ownership of more than 50% or there is common control, then we are going to club this in the investment limit for FPI. So the most important thing is not this part, but the part that the board has decided that the clubbing of investment should not be done on the basis of the beneficial owners criteria, which is prescribed under the Prevention of Money Laundering Act. So we are not going to apply the criteria specified in the Prevention of Money Laundering Act. So this is something which you must remember. And the criteria is going to be something different and it's a bit technical one. So even if you do not remember this as of now, it's okay, but you need to remember all this stuff. Now further, this move was based on the recommendations of SEBI working group under HR Khan. So this is again an important fact. Now another one is side pocketing has been allowed for mutual funds. Now this headline itself is very important and this term side pocketing also becomes important. Now SEBI has allowed the mutual funds that they can segregate their portfolio of debt and money market instruments subject to various safeguards. So this facility is going to be available to the mutual funds based on certain credit events. Now what is this side pocketing? What does this mean? Now what it is a mechanism to separate distressed, illiquid and hard to value assets from other more liquid assets in a portfolio. So in very simple terms and in very crude terms, I can say we are separating bad assets and good assets in the mutual fund portfolio. So what we are trying to do, we are trying to split those assets, and subsequent to the split, what we are going to do, the segregated portion with the bad investment is going to be closed or it is going to be set aside, while the fund house is going to focus more on the good part. So it is going to prevent the distressed assets from damaging the returns generated from more liquid and better performing assets. So we are going to segregate the good and the bad in the side pocketing. And at this moment, this is what you must remember, that this has been allowed for mutual funds. Another one is that scope of offer for sale has been widened. So friends, offer for sale we have discussed many a times as of now, and we are all aware about this particular mechanism as a tool of public issue. Now board has approved certain modifications in this OFS mechanism, and board is trying to expand the universe of firms which can avail this particular facility of offer for sale. So now what is going to be done? The OFS norms, offer for sale norms, are going to be eased. They are going to be made easier, and we are going to allow this mechanism, this OFS mechanism, for all the companies with a market cap of rupees 1000 crore and above. Now earlier this limit was that this OFS norms they're only going to be made available for a top 200 companies. But now this limit is going to be removed, and this is going to be made available to the companies with market cap of rupees 1000 crore and above. Now next is startup listing platform. So SEBI board has given its approval to rename the institutional trading platform as the Innovators Growth Platform, which is aimed at startups. So this is something which you should remember, that institutional trading platform is going to be renamed and it is going to be used for startups. Now for a firm to get it listed, it should be engaged in intensive use of new age technologies. So if you have to get yourself listed as a startup on this particular platform, you should be engaged in new age technologies. Further, 25% of the pre-issue capital should have been held by either qualified institutional buyers, family trust with over 500 crore net worth, category 3 foreign portfolio investor, or a pooled investment fund with minimum assets of $150 million, or an accredited investor with gross income of at least rupees 50 lakh annually. Now this is very technical points, and these need not be remembered as of now, but these are the points which you should remember, that there is this going to be renaming of this particular platform, and this platform is relating to startups which are in new age technologies, and also there is certain conditions with regard to the capital of these particular platform of this particular startups. Next is rules governing change in issue size. Now for this purpose, SEBI has amended its capital and disclosure requirement regulations. Now in case of any increase or decrease in the estimated issue size by more than 20%, a fresh filing of the offer document will be required. So what you are doing, you are coming up with an issue, and if you are changing the issue size by more than 20%, you have to come up with fresh set of offer documents. You cannot just say that this is going to be replaced with this particular amount. You have to come up with a fresh offer document. So at present, this requirement is there for both fresh issue of shares and offer for sale. But now a relaxation has been granted in the case of offer for sale, and the board has approved that a fresh offer document will be required only when the number of shares offered change by more than 50%. So if earlier you were offering certain amount of shares and now you are changing them by more than 50%, then only you are going to have a new or fresh offer document, and not in all the cases. So this is again a relaxation in terms of offer for sale. Now next is SEBI panel proposes direct listing of Indian firms on foreign bourses or foreign exchanges. So an expert committee which was set up by SEBI has recommended that SEBI should allow the listing of Indian companies on foreign exchanges even without getting listed in India. Now under the current regulations, any company which is incorporated on setup in India but not listed on any Indian exchange, it is not permitted to list its shares on a foreign stock exchange. So if a company is incorporated in India and wants to list its shares on, say, New York Stock Exchange, it must first list its share in India. Similarly, the companies which are incorporated outside India, they cannot directly list their equity shares on Indian stock exchanges. So similar is the case for the companies abroad who want to list their shares in India. Now, SEBI panel has recently said that this criteria or this drawback should not be there, and they should be freely allowed to set up their, they should be freely allowed to list themselves on the foreign exchanges as well. So this kind of framework, if it's true, it's going to be very helpful for the Indian companies to access the foreign capital at a lower cost. So if you have to access foreign capital, you need not get yourself listed in India. You can just simply list abroad. Now, with regard to this particular listing, there are certain conditions that listing may be allowed only on the specified stock exchanges, and that too only in permissible jurisdictions. So listing is not going to be allowed in all the stock exchanges across different parts of the world. This is only going to be permitted for a separate set of permissible jurisdictions. Now, what is a permissible jurisdiction? A permissible jurisdiction would mean a jurisdiction which has treaty obligations and which is going to share the information and which is going to cooperate with the Indian authorities in the event of any investigation. So permissible jurisdiction means that this is a very cordial jurisdiction with India, and India shares information with that particular jurisdiction. So the exchanges where the Indian companies can list their shares, they're the Nasdaq, NYSE, Shanghai Stock Exchange, Shenzhen Stock Exchange, London Stock Exchange, and Hong Kong Stock Exchange as per this particular criteria. Now let's learn more about the present framework. Now under the present framework, companies which are incorporated in India, have to list their debt securities on foreign stock exchanges, then they can do so directly through the masala bonds or the foreign currency convertible bonds. Now, masala bonds are the bonds which are issued outside India, but they are denominated in Indian rupees. Further, the companies which are incorporated outside India and they want to access the Indian capital markets, they can do that through the route of Indian depository receipts. So this is a link to the depository receipts. We have already discussed many times in different videos. Now next is a very important news that deadline for transfer of shares in demat has been extended. So SEBI has recently extended the deadline for transfer of shares of listed companies in demat form to April 1, 2019. Now earlier SEBI had decided that except in case of transmission or transposition of securities, request for effective transfer of securities shall not be processed unless the securities are held in the dematerialized form or a demat form with the depository. And this measure was to come into effect from 5th of December 2018. So now this has been extended till 1st of April 2019. Now this extension has been done due to the fact that SEBI has received many representations from different stakeholders who wanted that this date should be extended, and thus this deadline has been extended by SEBI. So friends, the next one is SEBI issues cybersecurity framework for brokers and depositors. So friends, we have many a time discussed that how SEBI is adamant on promoting cybersecurity, and in this regard, SEBI has issued the cybersecurity framework for brokers and depositories. So SEBI has put in place a very strict cybersecurity framework for stockbrokers and depository participants because there were concerns that there were data breaches. Now, stockbrokers and depository participants, they are performing some of the very significant functions which they are providing to the holders of securities, and these functions we have already discussed many times as of now. And considering the significance of these particular functions, SEBI has found that this is very much desirable and in public interest that these entities, they should have a robust cybersecurity and a cyber resilience framework. So for this purpose, the new norms are going to be effective from 1st of April 2019, and the stockbrokers and depository participants, they would be required to define the responsibilities of individuals who have the privileged access to networks. Further, no person should have any intrinsic right to access the confidential data by virtue of their rank or position. So only and only if they need that particular information for some particular purpose, then only they should be allowed access to the sensitive information. Otherwise, they should not have any intrinsic right to access that particular information. So in this respect, SEBI has asked the brokers and depository participants that they should formulate a comprehensive cybersecurity and cyber resilience policy document. And this policy document should be approved by the board or proprietor of the broker and the depository participants. So this policy document has to be prepared, and in this particular document, the brokers and depository participants, they're going to define the responsibilities of each and every employee, outsourced staff, employees of the vendors, members, other entities who are having privileged access to the networks. And further, no person by virtue of their position is going to be allowed any intrinsic right to the confidential data. So this is with regard to new cybersecurity and resilience framework for brokers and depository participants. Now next is SEBI difficult to recover tax for some defaulters is going to ease the court cases. So faced with difficulties in recovering the penalties and other dues from some defaulters, SEBI is planning to create a separate category of difficult to recover cases for optimal utilization of its resources. Now SEBI is of the view that treating the outstanding dues that cannot be recovered even after all the modes of recovery they are applied, then they should be categorized as difficult to recover. So this is going to help allocate the resources towards dues that have better chances of recovery. So those penalties and dues which are not going to be recovered, there are very low chances, they should be put in this particular category, and the focus should be on recovering those dues which can be recovered with ease. Now, SEBI presently has the powers to recover money from various entities, and for this purpose, it can impose penalties, it can charge fees, it can pass orders, so it can do all these particular aspects. Next is significant beneficial owner. SEBI comes out with a disclosure format. Now, listed companies, they're going to have another disclosure requirement. They will have to disclose about the details pertaining to significant beneficial owners in a prescribed format. So this move is going to come into effect from quarter ended 31st March 2019. And as per SEBI, listed entities, they need to disclose the details of the significant beneficial owner like name, PAN, nationality, etc., as well as the registered owner. So this move is going to bring in more transparency to the investors. So SEBI is going to take the details of the significant beneficial owner along with the registered owner. Now, what is a significant beneficial owner? Now, this is a person who is not a registered shareholder, but the person individually or jointly owns at least 10% stake in the company, or directly or indirectly exercises significant control over the company. So if you are having this particular 10% stake or you are having control, then this is going to make you significant beneficial owner or SBO. So this has to be disclosed. Now let's discuss some of the MCQs based on the topic we have just covered. The first question, SEBI has recently decided to allow side pocketing in the case of, options are alternative investment funds, mutual funds, collective investment schemes, or none of the above. So friends, this we have just discussed that side pocketing has been allowed by SEBI in the case of mutual funds. So here the correct answer is going to be option number B. Next question. SEBI panel has recently proposed direct listing of Indian firms on foreign bourses located in nearby jurisdictions, UN member states, permissible jurisdictions, all jurisdictions. So this also we have discussed that SEBI panel has proposed that Indian firms, they should be allowed to directly list on foreign bourses or foreign stock exchanges which are located in permissible jurisdictions. So here the correct answer is going to be option number C. Next question. Which of the following is are correct? Companies incorporated in India can list their debt securities on foreign stock exchanges directly through the masala bonds or foreign currency convertible bonds. Companies incorporated outside India can access the Indian capital markets only through the Indian depository receipts framework. Both of the above, none of the above. So friends, this also we have discussed that the present scenario with regard to Indian firms listing abroad and the abroad firms listing in India, both of these they are correct. So here the correct answer is going to be option number C. Next question. SEBI has recently extended the deadline for transfer of shares of listed companies in demat form to, options are 1st January 2019, 1st April 2019, 1st June 2019, or none of the above. So friends, this also we have discussed that the deadline for transfer of shares in demat form has been now extended to April 1, 2019. So here the correct answer is going to be option number B. So friends, these are the answers. So friends, this was all about our discussion pertaining to the SEBI current affairs for the month of December 2018 till date. Thank you.